Your $5,000 may be more valuable than someone else's $1 billion. First, that sounds ridiculous. If a billionaire said that to you, your first reaction would probably be, "That's easy for you to say. You already made it." But if you understand investing, capital, and opportunity, you start to see the point. This is not about pretending that being poor is better than being rich. It is not about romanticizing small amounts of money. It is about understanding one of the most overlooked advantages in the financial world. Small money can move. Big money often cannot. If you have $3,000, $5,000, or $10,000 today, you may feel like it is nothing. You may think it is too small to invest, too small to matter, too small to change your life. But Charlie Munger's Investing Life points to a very different lesson. When your capital is small, you can go into places large institutions cannot touch. You can move quickly. You can study tiny opportunities. You can make mistakes without destroying your life. You can build judgment before the stakes become massive. That flexibility is rare, and most people waste it. There is a famous story from Munger's early investing years. In the early 1960s, he invested around $1,000 in an oil royalty opportunity. It was not a glamorous investment. It was not a blue-chip stock. It was not the kind of deal that would appear on the front page of the Wall Street Journal. But it was small, overlooked, and understandable to the people involved. That $1,000 investment reportedly produced tens of thousands of dollars in cash flow within a relatively short period of time. Over the following decades, it continued sending Munger cash. The total return eventually became enormous compared with the original amount invested. The important lesson is not that you should go buy oil royalties. The lesson is this: the opportunity existed because the amount of capital required was too small for big money to care about. A huge fund cannot spend weeks analyzing a tiny local deal that might take $10,000 or $50,000. Even if the return is excellent, it does not move the needle. A billion-dollar institution needs opportunities large enough to absorb hundreds of millions. That requirement alone eliminates most small, strange, inefficient opportunities. This is why Warren Buffett once said that if he were managing only a small amount of money, he could achieve much higher returns than he can with Berkshire Hathaway's enormous capital base. Not because he would suddenly become smarter, because size is a constraint. A small investor can look at microcap companies, local businesses, special situations, obscure assets, small private deals, and neglected corners of the market. A giant institution often has to buy Apple, Coca-Cola, government bonds, major indexes, and other highly liquid assets. Those assets may be good, but they are crowded. They are studied. They are large enough for everyone. Small money has another option. It can go where the elephants cannot go. And yet, what do many ordinary investors do? They take their $5,000 and try to copy someone managing $500 billion. Buffett buys Apple, so they buy a few shares of Apple. Berkshire owns Coca-Cola, so they buy a few shares of Coca-Cola. That may not be terrible, but it misses the deeper lesson. You are not copying Buffett's skill. You are copying Buffett's current limitation. When Buffett was young, he was not simply buying the world's largest companies at fair prices. He was hunting for deeply mispriced situations. Tiny companies, liquidation values, overlooked balance sheets, businesses trading below cash, and what he called cigar butt investments. Those opportunities mattered to him because he was small enough to exploit them. To Berkshire Hathaway today, many of those deals would be irrelevant. They could be great investments and still too small to matter. That is the key idea. Do not play the big money game when you are still small. Small capital should use small capital advantages. The first principle is to go where big institutions cannot go. Large institutions are like elephants. They are powerful, but they are heavy. They need liquidity, legal review, reporting, compliance, scale, and career protection. They cannot turn quickly. They cannot chase every small opportunity. You, as an individual, can be more flexible. You can study a small company no analyst follows. You can understand a local business. You can learn an industry before it becomes fashionable. You can build a skill, buy equipment, start a side business, or invest in something that is too small for Wall Street to notice. The second principle is that when you truly understand an opportunity, Tiny bets rarely change your life. Most people finally find something they understand, then put 1 or 2% of their money into it. They call that risk management. Sometimes it is, but often it is fear disguised as discipline. If you have $10,000 and put $200 into your best idea, even a double does almost nothing for your life. The goal is not to be reckless. The goal is to recognize that meaningful outcomes require meaningful position sizes. Within risks you can actually survive. Concentration is not the same as gambling. Gambling is betting because you want excitement. Concentration is betting more heavily only after you understand the downside, the odds, and the reason you may have an edge. The third principle is that real safety comes from understanding, not from blindly owning everything. Diversification can be useful. For many investors, broad low-cost index funds are a perfectly rational choice. But diversification does not magically turn ignorance into safety. If you own 30 things you do not understand, you have not eliminated risk. You have spread confusion across 30 lines on a brokerage statement. Munger's broader lesson was always about avoiding stupidity. Know your circle of competence. Know what you do not know. Avoid games where others have the advantage. And when you find something simple, understandable, and mispriced, do not be afraid to act. So if you are starting with a small amount of capital, what should you actually do? First, stop judging your capital by its current size. Judge it by what it can teach you. Small money gives you a laboratory. You can learn accounting. You can study businesses. You can test your judgment. You can make a mistake and recover. That is a gift large capital does not have. Second, look for overlooked places. Not everything worth owning is on the front page. Sometimes the best opportunities are boring, local, small, operational, or hidden inside skills you can develop yourself. Third, be patient enough to understand before you act. Small capital is not a license to gamble. It is a license to learn quickly. Fourth, when you do find something you understand, size the bet seriously but survivably. Never risk money that would destroy your life. But do not pretend that a symbolic bet is the same as conviction. Fifth, give compounding time. The goal is not one lucky trade. The goal is to build judgment, capital, and opportunity over decades. No one can perfectly copy Charlie Munger or Warren Buffett. The era is different. Markets are different. Information travels faster. Your skills, temperament, and circumstances are different. So do not copy a stock. Copy the principle. Small capital has advantages when it is flexible, patient, curious, and disciplined. Your small amount of money is not embarrassing. It is not proof that you are behind. It may be the only stage of your financial life when you are not yet trapped by size, reputation, bureaucracy, or institutional rules. Use that stage well, because if you learn how to think while the money is still small, you will be much better prepared when the money becomes large.